The United States is at war. A real war. Airstrikes. Oil fields on fire. The world's most important shipping lane blockaded. Oil prices shot past $100 a barrel. Supply chains across the globe started breaking. Economists started using words like stagflation, recession, collapse. And then, the stock market hit an all-time high. I know what you're thinking. That makes absolutely no sense. Or does it? Because if you look at the last 100 years of market history, this is not crazy. This is actually exactly what the market does. Every single time. And by the end of this video, you're going to understand why, and more importantly, what it means for your money right now. Let me tell you exactly what has been happening in 2026. On 28 February, the United States launched joint airstrikes with Israel on Iran. What followed was one of the largest disruptions to global oil supply in recorded history. Iran closed the Strait of Hormuz, the narrow channel through which 20% of the world's oil flows every single day. Oil prices surged. Gas prices in parts of America crossed $5 a gallon. Inflation, which was just starting to cool, started climbing again. Every major bank on Wall Street started publishing recession warnings. Analysts said the market would crater. Investors panicked. Some sold everything. And then, something strange happened. The Nasdaq posted 13 consecutive winning sessions, a streak not seen since 1992. The S&P 500 climbed back to record highs. Individual investors who stayed calm, who kept their money in, who did not panic sell. They won. Again. Now you might be asking, how? How does the market go up during a war? And the answer is, because it has happened before. And every single time, the pattern is the same. Let me show you. We are going back 100 years. To show you a pattern so clear, so consistent, so undeniable. It is September 1929. The stock market has been on a 9-year bull run. Everyone is investing. Chauffeurs, cooks, bankers, everyone. And then, one of the most respected economists in America, a Yale professor named Irving Fisher, stands up and announces, "Stock prices have reached what looks like a permanently high plateau." Days later, the market began to collapse. By 1932, the Dow Jones had fallen 89%. 89%. If you had $10,000 saved, you were left with $1,100. Banks failed. Jobs vanished. Soup kitchens stretched around the block. The Great Depression lasted over a decade. And yet, the market recovered. Fully. Completely. It took 25 years, but it recovered. And $1 invested in 1926, through all of that chaos, is worth $20,000 today. Let us fast forward to 1960. The world is 13 days away from nuclear war. Americans are building bomb shelters in their backyards. The president is on television telling the nation that Soviet missiles are 90 miles from Florida. The stock market dropped 22% in weeks. Recovery time? Less than 1 year. Because when the fear passes, money moves fast. Now here is the one that should really get your attention. Because this is the historical moment that looks most like right now. It is 1973. The United States backed Israel in the Yom Kippur War. In response, Arab OPEC nations cut off oil exports to America overnight. Oil prices quadrupled, inflation exploded, economic growth collapsed. Sound familiar? Today, we have tariff shocks driving up prices. Growth is slowing. The Federal Reserve is stuck between fighting inflation and supporting the economy. In 1973, the market fell 52% and took 8 years to fully recover. 8 years. But here's what nobody talks about. The investors who kept buying through those 8 years were millionaires by 1990. They didn't time the bottom. They did not wait for clarity. They just kept going. 19th October, 1987. The Dow Jones fell 22% in a single day. Not a week, not a month. One day. Traders were in physical shock on the floor of the New York Stock Exchange. Recovery time? 2 years. Why so fast? Because the economy itself was completely fine. It was pure panic, a computerized feedback loop that spiraled out of control and then corrected itself. Here's the lesson. Market fear and economic reality are two completely different things. One is emotion, the other is data, and data always wins. The dot-com bubble, the year 2000. The internet is going to change everything. Companies with zero revenue are worth billions of dollars. People are remortgaging their homes to buy tech stocks. Then the bubble burst. The Nasdaq fell 78% and took 15 years to recover its peak. 15 years. But here's what most people miss. The S&P 500, the broad, diversified index, recovered in just 7 years. Diversification saved investors from a 15-year nightmare. If you were spread across industries, you were back in the game in 7 years. If you were concentrated in tech, you waited 15. That lesson still applies today. The global financial crisis, 15th September 2008. Lehman Brothers, one of the largest investment banks in the world, declared bankruptcy. Global credit froze overnight. The S&P 500 fell 57%. Governments around the world injected trillions of dollars to stop total collapse. Commentators called it the end of capitalism. Recovery time, 5.5 years. And the decade that followed? The greatest bull market in American history. The investors who stayed in made life-changing returns. The investors who sold at the bottom locked in permanent losses and missed everything. And then 2020, a global pandemic. Economies shut down overnight. The world came to a halt. The S&P 500 dropped 34% in just 33 days, the fastest crash in stock market history. Half the internet told people to sell everything, move to cash, move to gold. Recovery time? 5 months. The people who sold in March 2020 and waited for things to settle down. By the time things settled down, the market had already recovered. They sold low, they bought back in higher, and they called it protecting themselves. Do you see the pattern? 1929, crashed 89%, recovered. 1937, crashed 49%, recovered. 1962, crashed 22%, recovered. 1973, crashed 52%, recovered. 1987, crashed 22%, recovered. 2000, crashed 49%, recovered. 2008, crashed 57%, recovered. 2020, crashed 34%, recovered. Every single time. In 150 years of stock market history, there have been 19 major crashes. The market has recovered from all 19. $1 invested in 1926 is worth $20,000 today. Through 2 world wars, through nuclear standoffs, through oil embargoes, through a global pandemic, through tariff wars. So let me ask you this. What makes you think this time is different? Okay? Let us talk about what to actually do with your money right now. Because stay calm is not a strategy. Here are 5 specific moves that make sense in a tariff war environment. Move 1. Do not stop your SIP. Speed it up. If you're running a systematic investment plan, this is exactly the environment it was designed for. Every month you invest at these lower prices, you are buying more units. When the market recovers, and based on 100 years of data, those extra units become extra profits. Volatility is not your enemy when you are a regular investor. It is your discount. Move 2. Tilt toward commodities and energy. When tariffs drive inflation, the prices of goods rise. The companies that produce those goods, energy, metals, raw materials, tend to benefit. In the first quarter of 2026, commodities and energy stocks led all asset classes in performance. Consider allocating 10 to 15% toward a commodity or energy index fund. Not all in, just a tilt. Move 3. Add inflation protection. If tariffs keep prices elevated, regular bonds lose real value. Treasury inflation-protected securities, called TIPS, adjust their returns with inflation. Gold has historically held value in high inflation, low-growth environments. Even a 5 to 10% allocation acts as a shock absorber for your portfolio. Move 4. Look internationally. Here is something that might surprise you. Since the start of 2026, international stocks are up over 15%. The S&P 500 is barely positive. Markets like India, Japan, and Brazil have sold off and now look genuinely cheap. Move 5. Never try to time the market. Research shows that missing just the 10 best trading days over a 20-year period cuts your total returns by more than half. And those 10 best days? They almost always happen right after the worst days. The investors sitting in cash, waiting for clarity, are the ones who miss the recovery. As Wise Investor puts it, the market often comes back fast and unexpectedly. The biggest mistake investors make is trying to time it and not being there when it does. So, why is the stock market at all-time highs during a war? Let me answer that with one final story. The year is 1973. The Arab world has just cut off America's oil. Inflation is at 12%. Growth is collapsing. Sounds familiar, does it not? A young investor, 25 years old, keeps putting money into a diversified index every single month. His friends think he's crazy. By 1990, he is financially free. Because he understood something most people never learn. The market does not reward the most intelligent investor. It rewards the most patient one. Wars end, recessions end, pandemics end, oil shocks end. The market has never permanently collapsed, not in 100 years, not in 150 years. And the single best time to invest? When everyone else is too scared to. If this video helped you think more clearly about your money, share it with one person who needs to hear this right now. Subscribe for more videos like this. We are just getting started. And drop a comment below. Are you buying, holding, or selling right now? I read every single one. Let us talk.